Good day, good afternoon, good morning. I'm Arunabha Ghosh. I'm the CEO of the Council on Energy, Environment and Water. It's a great pleasure for me to welcome you to this important discussion on India's journey towards 500 gigawatts of non-fossil electricity capacity. We bring this program to you from the CEW Center for Energy Finance and the International Energy Agency. I just want to outline three important points. First, the targets that India has set out as per the Honorable Prime Minister's speech on the 1st of November in Glasgow is not a call for an energy transition, it is a call for an economic transformation. It means that everything will change, starting, of course, with the decarbonization of the power sector. Second, in order to achieve these energy transitions, we will need to have a significant step up in the access to clean finance. There are two fuels in any economy. One is energy, the other is finance. And we will not be able to do that until we have the commensurate finance flows that meet these targets. And therefore, number three, we have to acknowledge that we are nowhere near the kind of investment that is needed. The pandemic-induced slowdown of the economies across the world is something that hit the renewable energy sector in India as well. But we also see that there are signs of change and dynamism in the sector. Today, we will bring to you a discussion based on two very important documents. First will be the Renewables 2021 report, which is the IEA's primary analysis on the sector, and you will hear about the India-specific analysis that the IEA has done. You will also learn from the Clean Energy Investment Trends report, which is a joint product of the Council on Energy, Environment and Water and the International Energy Agency. In fact, this is the fourth edition in which we monitor the market activity and identify the market and financing trends to provide a practical guide to stakeholders in government and in industry to understand the interactions between risks and regulations in shaping investment flows. I'm not going to reveal to you what these reports find. You will learn more about them in due course. But I do want to take this opportunity to, first of all, thank our collaborators in the IEA. You will hear very soon from Mr. Tim Gold, Chief Energy Economist, the International Energy Agency. And then you will hear from Hemi Bahar, Senior Analyst at IEA on the Renewables 2021 report, and Pablo Gonzalez, the Investment Analyst at IEA on the Clean Energy Investment Trends report. You will also learn from an expert panel comprising Aditya Aggarwal, the CEO of Global Infrastructure Partners, Singapore and GIT India partner, Ambalika Banerji, Executive Director of Direct Investments for the National Investment and Infrastructure Fund in India, from Deepak Gupta, Senior Vice President of Renew Power, and from Surbhi Goyal, Senior Energy Specialist of the World Bank. That panel will be moderated by my colleague, Arjun Dutt. On your screens, you can also see my dear friend and collaborator, Pablo Frankel, the head of renewables at IEA. That's enough from me for now. And I now want to hand it over to Tim Gold, the Chief Energy Economist of the IEA, to bring in his perspective on why the conversation we're having today is critical for India and for the world. Tim.
Well, thank you very much, Ananab, and greetings to everyone. I'll be very brief. We have a lot of interesting material to cover, and we have a really great panel. But I completely agree with you. As we come out of COP where we saw this momentous announcement from India of its net zero ambitions, we have to knuckle down again to this huge task of transforming the global energy sector. And I really struggle to think of a more important task now in global energy than to reinforce the momentum behind deployment of clean energy technologies in India. So I'm delighted that we're able to continue this joint work with you on the fourth edition of India's Clean Energy Investment Trends. Many thanks to you, Aranabu, for your leadership on all of these topics and your collaboration with IEA, and also to Gagan and particularly to Arjun and his team for the excellent collaboration with colleagues here at IEA. And as you mentioned, we'll be hearing shortly from my colleague, Pablo Gonzalez, on the key findings of that joint work. But I'm also delighted that we have the opportunity today to work together with colleagues from our renewable energy division, with Paula Frankel and Hemi Bahar, which allows us to put this detailed work on India into the broader context of trends in global deployment and costs. And so without any further ado, I'd like to pass the floor across to my colleague Hemi, who can give us that broad scene-setting context for our discussion today.
Thank you very much, Tim. Thank you very much for the invitation. I would like to present the first presentation of this event, and this will be based on our recently published Renewables 2021 report, which is a 5-year forecast that we publish. And India has a very specific place on this. So the slides that you will see on India were not published. So this will be the first time that we will do a deep dive on India. I'd like to start with the global situation. We said that in 2020, capacity growth of renewables, namely electricity annual capacity additions, were increased tremendously despite the COVID-19 challenges. And we called renewables at the time a resilient to the COVID-19 crisis because the annual capacity additions increased by 40%. How did this happen? Renewable industry adapted very quickly to the new conditions, and in addition to that, there was incredibly ambitious policies which had specific deadlines. 2021 was a critical year with new challenges such as the high commodity prices, which I will touch upon. So another record year, or we'll see in our expectations, another record year. This is also driven by the policies and ambitious climate goals that were in the preparation of COP26, which led many countries to improve their forecasts, which led us to a forecast which is continuously increasing towards 2026. However, there is still a general challenges that the countries face that need to be addressed. These are simply 3 challenges that I would like to mention here, which I will also relate to them in my presentation on India. First of all is the policy uncertainty and regulatory challenges. So still there are many of them exist. The second one is, which is also relevant for India, is the financing challenges, which my colleagues will present in the coming minutes about their results. And the third one is basically the grid infrastructure and grid integration, where it remains an important challenge. If countries address those challenges in the coming short term, we have an accelerated case forecast, which is 25% higher, which is very well possible because we are not adding new ambition in the accelerated case forecast. We are basically suggesting certain policy and regulatory changes that will lead to this forecast if governments address those challenges.
Sorry, Jaime, can I interrupt you just one moment? Could you reshare your screen, please, because it got stuck in the first slide?
Of course.
Thank you.
Sorry about this. Can you see?
Not yet. Now it's coming. Now it's okay.
I can see it.
Perfect. Thanks.
Is it okay?
Now no. Can you reshare it again, please?
Sorry, somebody changed the sharing. Just doing it now.
Now it's perfect. Now it's
okay.
perfect.
Thank you. Sorry about this technical problem. And just to put India into the context and in terms of the other regions and countries, we expect with these new policy improvements, China remaining the main leader, obviously, followed by Europe, United States, and India. In the next 5 years, we expect all regions to accelerate their deployment. And we see that India in terms of the growth compared to last 5 years, will basically double its growth rate and then basically becomes actually among the key economies the fastest growth rate compared to last 5 years. We expect many countries to actually on track to overshoot their targets, such as China and the European Union, and the United States is going very rapidly. What is leading the forecast in terms of the technologies? Obviously, wind and solar PV are at the heart of the renewable energy expansion globally. And we see that they already represented 80% last 5 years. In the next 5 years, we expect there will be further consolidation in the renewable energy market, where almost 90% of all capacity additions in our main case will come from only wind and solar PV, with solar PV accounting almost 60% of the growth. This global picture is an incredible improvement in terms of increasing the role of renewables. We expect this growth to represent 95% of the increase in global power capacity in the next 5 years. Obviously, renewables are basically taking intake, but as I mentioned, we are seeing also wind and solar expanding rapidly, while other renewables such as hydropower, bioenergy, geothermal, and CSP are basically falling behind. This is an important point because these technologies are dispatchable and can help integrate wind and solar PV easily. Our main case also shows a similar trend than the main case in terms of role of wind and solar PV, but obviously 25% higher growth, where we see obviously the wind significantly increasing while because wind technologies have an important challenge such as permitting, which we consider in the main case and those addressed in the accelerated case, while solar PV still is in the leading role and which could add about 2,300 gigawatts in the next 5 years in our accelerated case. An important topic which we analyzed very high and which has a direct implications on India is the high commodity and energy prices. The cost reduction trajectory that you see in the screen has been a given for renewables for the last decade almost. And this was our projections towards 2026 before we basically had this high commodity and energy prices. However, the situation looks already very different in 2021. Already we saw 15 to 20% increase in the investment cost of onshore wind and solar PV because of the skyrocketing prices of not only the commodities such as aluminum, metal, steel, or polysilicon, but also the freight prices or transportation costs, which I'm sure the industry may like to refer to in our discussion. If those prices continue to remain high in 2022, we actually expect onshore wind investment costs going back to 2015, erasing basically 5 years of cost reduction. And for solar PV, this will be 3 years of erasing cost reduction, which will lead into additional investment needs for the same amount of capacity that countries need to deploy, which is about 100 billion for the same amount. Obviously, this situation puts many parts of the supply chain at risk, but the most vulnerable point that we basically pointed out in the report, which amounts to 100 gigawatts, that are those that bet into the auctions prices, thinking that the cost will continue to decline, but they have a new cost picture in their hands and they have strict delivery deadlines for their contracts. So this is about 100 gigawatts of projects we see at risk of delays in the coming years if commodity prices remain high. Looking at India, India's growth doubles in the next 5 years compared to last 5 years. And this is mostly driven by a tremendous share of solar PV, both utility scale and distributed PV. This is driven mostly by the auctions, compared to auctions that India has been extremely successful. We improved our forecast slightly for India to take into account, first of all, the ambitious target, and the policies that are on the implementation level that has been improved. Most notably, improved rules basically led to a better auction subscription rates, which is a good development, and several improvements on the distributed PV, which we work very closely with the MNRE as an IEA and CEEW on these topics. But still, several challenges remain, especially concerning DISCOM's financial health and land acquisition and financing. If those general challenges are met, actually India's potential is incredible in the accelerated case. We can see more than 30% higher growth. And I would like to point out the role of distributed PV here, which has a tremendous potential, but basically several challenges remain on the policy design. And let's look at how this accelerated case actually puts India in line with the 500 gigawatt target. If the accelerated growth pace continues beyond our forecast, India, according to us, is well in line with the 500 gigawatt forecast. But I would like to point out a very important point, that this is an accelerated case discussion, which there are still several challenges that I like to point to in the coming two slides. The first one is auctions. An important leader India it is, and it saw an incredible cost reduction. And basically long-term contracts reaching 30 years contribute significantly to the lower auction prices. India has one of the highest contract lengths in the world, and prices have been declining significantly over the past probably 6-7 years. India accounts actually a significant part of the global auction volumes, ranging depending on the year, 30% to 40%. And the prices that we see on solar PV in India is actually lower than the global averages in the world, which is China is one of the lowest basically contract prices that we see. However, obviously high commodity prices pose new uncertainties on the one hand. On the other hand, India prepares the ground for hybrid multi-technology plus storage auctions, which is extremely innovative, which actually followed by worldwide right now, to have a different type of product, which is firm, also opening the way for the pumped hydro storage projects that can provide long-term storage. However, one important challenge remains, which is critical for the growth, is the poor financial health of DISCOMs. I'm sure the panel and my colleague Pablo will refer to this several times. COVID actually made the situation worse than before in terms of the overdue payments of the generators and renewable energy generator increasing over time, which is an additional risk and leads to delays in PPA signing and several other issues. But also the credit ratings of the DISCOMs at the lowest level has also increased significantly with recent data pending. So this is the largest challenge that the government and the several financial institutions needs to address in order to basically accelerate the investment. I would like to highlight one important point. We are talking about here is electricity, obviously, but India is becoming a leader of ethanol, one of the leaders of the ethanol production in the world. As you can see in our forecast, the growth significantly accelerates, making India the third largest market, surpassing China in terms of the ethanol production, driven by the government's 20% blending policies. I'd like to finish with one important message. This is a global picture that you see on my screen. It's not India. It's from IEA's Net Zero by 2050 report. And obviously, both our main and accelerated case on electricity and biofuels are not on track to reach the net zero, which requires doubling the growth of our main case in accelerated in the electricity, and also more than quadrupling the biofuels growth in the coming years globally. Obviously, India plays an important role. And I would like to finish my presentation here. and give the floor to my colleague Pablo to continue his presentation. Thank you very much, and sorry for the technical problem.
So thank you very much, Jaime, for this interesting presentation. I'm just sharing with you my screen. I would like you, Jaime, to tell me if it's okay, if you're seeing it correctly. Everything is okay? Great, perfect. So now I will present some of the key findings from the Clean Energy Investment Trends 2021 that we are launching today. Apart from what Arunabha just shared with you, this year we have updated former analysis and trends, such as project debt and equity finance or market concentration that we had in the 3 previous versions. And we have also added some new analysis, such as the one on hybrid tenders. The period of analysis of this report centers over July 2020 and June 2021 for plain vanilla tenders and for hybrid projects awarded in 2020. We also focus on utility-scale solar PV and onshore wind mainly. So let's begin by solar PV and wind capacity in India. We can see very clear the effect of the COVID-19 pandemic on new commissioned capacity for solar PV and onshore wind if you go to the left part of the chart. After this bump in the road, we have seen a considerably recovery and we reached pre-pandemic levels in the first half of 2021, mainly driven by solar PV. However, the picture is somehow different in terms of capacity awarded. While the first half of 2020 was very resilient, with more than 15 gigas of capacity awarded, it dropped sharply to 2.6 gigas in H1 2021. Another important trend that this chart reveals is the preferences for solar PV versus wind. In fact, tendering of fresh capacity and challenges with the availability of sites resulted in no wind capacity awarded in 2020, with only 1.2 gigas awarded in H1 2021. So what's behind this deceleration in terms of capacity awarded? The chart on your left is quite revealing. As you can see, there is a change of trend in H1 2021 in terms of the type of off-takers behind solar PV capacity tenders. You can observe that state off-takers dominated capacity awarded in the first half of 2021. But this is not the result of a state off-takers accelerating the levels of tendered capacity, but rather the opposite. Capacity tendered by central off-takers considerably dried up. And this is because there is a backlog of unsigned power sales agreement with the Solar Energy Corporation of India, with SECI, of around 20 gigas towards the end of 2020. These power sales agreements correspond to capacity awarded at higher tariffs compared to the average solar tariffs in recent times. For instance, let me mention that we got record low tariffs of around 2 rupees per kilowatt hour at the end of 2020. Central off-takers still dominated the wind space, as you can see on the right-hand chart. Now moving to project debt and equity trends, as you can see in this slide, in 2020, the pricing of project level debt improved slightly thanks to 2 main drivers: an accommodative monetary policy and higher participation of central public sector undertakings, CPSUs, and international power producers in tenders. Let's begin with the first factor. Over much of the period of analysis, the Reserve Bank of India maintained an accommodative monetary policy to support the domestic economy against COVID-19 pandemic, which is very much in line with what other central banks did. As you can see in the left-hand chart, interest rates charged by non-banking financial companies, NBFCs, for renewable energy loans decreased by 100 basis points. Now, as we pointed out in the last year report, lenders don't have homogeneous strategies and the cost of debt varies depending on the type of site and the creditworthiness of the off-taker. For instance, solar parks command a small advantages of around 25 basis points in borrowing costs relative to non-solar parks, or less creditworthy state discoms could have up to 50 basis points in borrowing costs versus projects with central government entities or better creditworthy state discounts as off-takers. Further, a number of CPSUs are now actively bidding for projects, you can see there in the green bar. These state-owned enterprises typically access the bond at costs close to sovereign borrowings of around 6 to 6.5%. However, given the longer tenure of renewable energy projects compared to that of bond market borrowings, we have factored in slightly higher costs of debt. We found a similar trend in the case of equity IRR expectations. In this chart, whereas the dots represent estimated equity IRR for the most competitive bids awarded in solar PV tenders, the bars, the blue bars, show the weighted average values for each semester. And as you can see, there is a declining trend for equity IRR expectations since the second half of 2019. But I would like to drag your attention to the green box in the middle of the chart. This is the moment where central public sector undertakings started to bid in tenders. In fact, the two red boxes inside the green box correspond to the record low tariffs values of 1.99 and 2 rupees per kilowatt hour. Since then, CPSUs were awarded capacity in 6 out of the next 10 tenders, 6 out of the next 60%, which is coherent with their last corporate decisions to get to greener asset portfolios by adopting renewable deployment targets. This participation drove aggressively bidding across tenders and led to lower equity IRR expectations from November 2020 onwards. Now let's move to the 4 new analyses that we have done in this version of the Clean Energy Investment Trends 2021, starting by hybrid tenders. We see that the Indian renewable sector, once again, is leading innovation in procurement of renewables. So we know that plain vanilla tenders, those for single technology projects, have helped India scale renewables deployment. But the country has introduced innovative tender designs to reduce output variability and facilitate renewables grid integration. As you can see in your left-hand chart, solar and wind have similar average capacity utilization factors, if we consider obviously high overloading for solar, but they have very different hourly production profiles. In fact, they are, in average, complementary. And this is why hybrid solar plus wind tenders are so interesting. But instead of imposing a determined quota for solar PV or wind, these mechanisms give the freedom to developers to find the optimal configurations that can satisfy a series of requirements. And to me, this is the key innovative step. Just let the group of developers compete ones against others to discover these optimal configurations. Now, among the series of requirements of these hybrid tenders, we have highlighted 3. The minimum CEEW-CEF required, that can be either 30 or 50% in the tenders that we saw. Allowing or not for oversizing. So this means that, for example, for a 500 megawatt plant, you are allowed to build more than 500 megawatts, but not to produce, so you would have curtailments in some hours. And the location, where you can either have the freedom to collocate or not the wind and solar PV projects. Finally, we have seen that the equity IRR expectations for hybrid tenders with central government off-takers, you can see that on the right-hand side, right-hand chart, were between 100 to 150 basis points higher than those for comparable solar PV plain vanilla tenders. Now, as my colleague Jaime shared with you, given current inflationary pressures, realized returns can be affected by higher construction and equipment costs. The chart on your left hand shows that the price of polysilicon, aluminum, and silver, which are raw materials used for renewable projects, has considerably increased in the period of analysis. Now, modules typically comprise around 50 to 60% of total capex, and thus, variation in realized prices from modules assumed at the moment of the tender can have a material impact on realized returns. This is exactly what we tried to explore in the sensitivity analysis on the right-hand chart. So we have discovered that a 20% increase in realized module prices from those assumed at the moment of the most competitive tariffs could lower equity returns by around 45%. In addition, apart from the supply chain factors that are affecting the sector, the government of India decided to levy the basic custom duty on cell and module imports from April 2022. So this is likely to prompt the developers to advance their module purchases to beat the deadline, and this may further increase the upward pressure on module prices. The equity IRR expectations of solar PV projects in India appear high when we compare them to other countries. For instance, these are 2020 figures. The average equity IRR for utility-scale solar PV projects awarded in 2020 was over 2 times higher than the corresponding for the United States. So you see there the 14.9 versus the 6%. So we wanted to understand what's behind this big gap. When evaluating projects across countries, investors factor in multiple risks. So you have country risk, currency and inflation risk, sectorial risk, and liquidity risk. But we could say that the local currency sovereign bond yield, the 10-year government bond, factors in already the country and the currency risks associated with investment in renewable projects. The premium then would reflect the rest. And you see there the big difference in terms of spread. Assuming similar perceptions regarding liquidity, technology, and operational project risks, the difference in spreads in India compared to international markets is around more than 300 basis points. If you just direct your attention to the spreads. And this reflects higher off-take risk as well as challenges with land availability and transmission constraints. So the implications are clear. Investor return expectations in India could be lowered by around 300 basis points if challenges such as the poor financial condition of distribution utilities and challenges associated with the timely availability of land and transmission can be addressed. I would like to end my presentation with this slide on acquisitions. Acquisition activity in India has rebounded strongly from 2020. So from less than $1.5 billion to around $6 billion, and this was led by Adani Green Energy's acquisition of SB Energy at an enterprise value of $3.5 billion. This is an indicative of the move towards greater scale and consolidation in India's solar PV and wind markets. Now, asset sales are very interesting for both buyers and sellers, as you can see in this final figure. And please note that these values are obtained from our internal calculations. They are not official data, okay? They are obtained from internal calculations. So asset sales are a means for project owners to realize higher returns, allowing them to swiftly recover the capital and reinvest this in new projects. However, note that these higher returns are realized over much shorter durations, 3 to 4 years, and this exposes sellers to reinvestment risk. At the same time, asset sales are a good opportunity for investors, and although they generally realize lower returns than those realized by the seller, they profit from the lower risk profile and that operational assets provide, and they avoid the execution of construction risk, which is typically linked to greenfield assets. So all in all, solar PV awarded capacity dropped in the first half of 2021 due to the backlog of unsigned power sales agreement by central off-takers, and wind capacity awarded remained limited due to the lack of tender capacity and the availability of suitable sites. Both project debt and equity expectations declined in the period of analysis, influenced by the increased participation of central public sector undertakings. Solar wind hybrids are a very interesting option for better integrating solar PV and wind into the grid. Volatility from module prices pose a downside risk in realized returns. Equity IRR expectations could be lowered by addressing sectoral challenges, and acquisitions of renewable power companies are a good opportunity for the Indian renewable market. Now, I finished there my presentation, and I would like to say that I will share with you in the chat the links to these both reports, the one that Jaime presented and this one, and I hand it over to you, Arjun, for the very, very interesting panel discussion. The floor is yours, Arjun. Thanks.
Thank you very much, Pablo. If you can just stop sharing your screen, I'll begin.
There it is.
All right, perfect. All right, hello everyone, and a very good day to you, wherever it is in the world that you're joining us from. The year 2021 has witnessed a firming of the global resolve to decarbonize, and particularly so in India. India's net zero by 2070 target was among the prominent announcements at COP26. At the same time, this was complemented by shorter term objectives, including the 500 gigawatt target for non-fossil fuel-based electricity capacity by 2030, which is of course the focus of today's discussion. India's renewables policy and market ecosystem has already delivered 150 gigawatts in installed capacity in renewables, if we include large hydro, with another 60 gigawatts under construction. However, the flow of investments needs to rise considerably in order for India to achieve the 500 gigawatts target. I'd like to once again thank my colleagues Hemi and Pablo for setting the context by summarizing the key findings from the Renewables 2021 report, as well as the Clean Energy Investment Trends 2021. These data-driven insights on market and financing trends ultimately serve as markers that indicate whether India is on the right trajectory towards meeting its clean energy ambitions, or if course corrections are needed along the way. To discuss these very matters, I'm honored to be able to pick the brains of a most distinguished set of panelists for today's deliberations. We have with us Mr. Aditya Aggarwal, CEO of Global Infrastructure Partners Singapore, and partner and member of the investment committee of the GIP India Funds. In his 23 years long career in infrastructure finance, apart from various other endeavors, Aditya built Vector Green, which is GIP's renewables platform, and took it to its current portfolio of 750 megawatts. We also have with us Ms. Ambalika Banerji, who is the Executive Director, Direct Investments at the National Investment and Infrastructure Fund. Ambalika oversees funds that invest in the infrastructure space, including renewable energy. She has over 30 years of experience in private equity, debt financing, debt structuring, restructuring advisory in India, as well as across Asia. We're also honored to have with us Mr. Deepak Gupta, Senior Vice President at Renew Power. He heads Renew's Policy Advocacy and Regulatory Affairs Division. So he's responsible for handling energy sector-wide policy and regulatory aspects of the business. And of course, Deepak has been doing this in his previous avatars as well, where he's extensively worked in the policy and regulatory space and has over 20 years of experience doing so. And last, by no means the least, we have Ms. Surbhi Goyal, Senior Energy Specialist at the World Bank. She's been associated with the bank's energy and extractive global practice for over 13 years now, and has led the bank's work with the Power Grid Corporation of India, which is, of course, India's central transmission utility, and was integral in the achievement of its motto of one nation, one grid, one frequency. To my panel of superstar industry experts, a very, very warm welcome to you all. So before we get started, for all those attending, please feel free to use the chat or Q&A functions to send in your thoughts and comments, and we'll try and pick on these themes as we go along the way. With that, let's get started. So, when we're talking about 500 gigawatts, of course, India doesn't have to, build from scratch or reinvent the wheel. We already have a policy and market ecosystem which has delivered 150 gigawatts in terms of investments. So let's start with understanding from the investors, what is it that has enabled India to deliver this scale of investments? So Aditya and Ambalika, since both of you represent equity investors in renewable energy platforms in India, I'm going to start with the two of you. Aditya, perhaps you can kick us off by talking about the perspectives of global investors such as yourselves. Why is the Indian market attractive, and how does it compare with other developing country markets? Over to you, Aditya.
Yeah, thanks for that, Arjun, and thanks for having me as part of this webinar. Now, a couple of points. One is, of course, the overarching impetus is irreversible, and we'll talk about the near-term headwinds that were also alluded to. But I do want to kind of start off by saying the concerns around climate change, which have been taken on board by governments across the world, as well as corporates and institutions, is something that is not going back. So from that perspective, there would continue to be a lot, much more development as far as renewable projects are concerned, backed by significant capital flows across the world. Coming to India, just 2 data points is enough to kind of talk about the attractiveness of the market. One, of course, is this EY index that places India as number 3 in terms of attractiveness for a renewable market. But more importantly, is the $70 billion that have flown into the country just over the last 6 years to build out, all the capacities that were talked about. And I think, there were a couple of main reasons as to why India stacks out amongst various growth countries. First and foremost, of course, is the support and commitment that comes in right from the top, right from the Prime Minister kind of laying it out in terms of how important it is for the country gives global investors a lot of confidence and comfort in terms of sustainability of this program. And if one were to just look back, 4 or 5 years back, the capacities were minuscule. And from those capacities to have come to 150 gigawatts is no mean task. So the momentum, we firmly believe is going to continue because it kind of comes in, right from there. And of course, that has been very ably carried forward by earlier Power Minister, Mr. Piyush Goyal, and now, of course, Mr. Singh. So that kind of helps develop more confidence and comfort. Second most important thing, as far as global investors is concerned, is the scale that India provides, right? Which is quite important for people who are looking at putting significant capital to work over the next 5-10 years. So in that context, India is one of the very few markets, certainly in the region, which has the capital absorption capability if kind of, the near-term hiccups get resolved. Linked to that point, of course, is the economic growth and the demographics, which will continue to provide, a lot of scale or the, possibilities of projects coming through in the coming years. So these, I think, 2 or 3 things are really on the top of the mind when we look at India as an investment destination. And I wouldn't even talk about things that everyone knows in terms of resource richness of the country and the maturity of the regulatory framework as compared to a lot of other geographies. And of course, rupee being, quite stable over the last 3 or 4 years also helps, us to take some calibrated calls around currency risk.
Thank you, Aditya. I mean, things like the momentum is irreversible is music to the ears of those of us trying to, mitigate climate change, and may the momentum accelerate further. But you made some valid points, and Ambalika, I'll come to you next. Of course, Aditya pointed out the macroeconomics, the scale, and the overall policy support that comes at the top. Of course, the NIIF also, just last year, increased its equity stake in IEA Renewables to acquire management control, and has been investing in both greenfield as well as operational projects. So from your perspective, maybe you can add to what Aditya stated. But in addition, perhaps you can also compare the relative attractiveness of, let's say, greenfield investments versus operating assets. Because of course, as a platform, IANA, and of course, as an investor, NIIF invests in both. Over to you, Ambalika.
Thank you, Arjun. Thank you for having me on this panel. I think Aditya has given a very eloquent overview and covered all of the points, all of the main points that really, explain the sector as it stands today. Let me try and add a little more from the perspective of NIIF and IANA. You're right, NIIF via IANA has really stepped up its game, so to say. And we have seen, surprisingly perhaps, in the last 12 months, we've added to our portfolio from about 1.1 gigawatts to about 3 gigawatts. Now, this 3 gigawatts is in various stages of development and operation. About 900 megawatts of this is really operational, and the balance is under development. We have done it through a mix of acquisitions and auctions. So what this really signifies is that there has been a steady stream of projects that have been auctioned out. I think that there has been a healthy flow of. Yes, what we have seen headwinds in is, while the projects have been bid out, and we've really participated mostly in SECI NTPC tenders, the past sales agreements behind those have not taken off at the same pace. And that is why you perhaps see such a big gap. That's one of the reasons you see a big gap between, projects that we have on hand and projects that are operational. And we've been trying to make up in the meantime by really getting assets that are, under the M&A spectrum, that are operating assets. Now, these are very hotly, fought. And you all probably know what happened in case of the SoftBank portfolio. I think many of us here were part of it, part of the, those aspiring to buy that portfolio. But, every asset, whether a single asset or, right, we've even done a 40 megawatt acquisition to an 8 gigawatt portfolio is hotly fought. So it is a market that is hugely attractive to all investors. We have some big domestic investors, and we have a lot of international investors that are interested. Overall, I mean, I think our international investors are not comfortable doing development because of the issues that we know. There are regulatory issues. More importantly, there are land-related issues. Execution, they're not comfortable. You have to set up a team, have people, feet on the ground. You have to deal with discoms on an ongoing basis. But by and large, they're not comfortable doing it directly. They'd rather do operational assets. In what we've done in IANA, and we've, as you rightly said, we've actually gained majority in IANA over the last 1 year. We've built an excellent team that has both the capability of developing assets and of managing and operating them. So we aren't doing the construction of these assets yet, of these projects yet. That is outsourced. That is being done by some others. But we can definitely manage the development risks and execute. So yes, there is a clear divide. I think if we want to be in the game and want to get the kind of returns that we're looking at, which are relatively moderate, I must say, we have to get into the development game.
Right. Thank you, Ambalika. And I mean, of course, long-term fundamentals are good, but you made some very valid points. It's also important to be a realist. And I heard headwinds and short-term challenges from both yourself and Aditya. And of course, you laid out some of these challenges for us. So Deepak, let me come to you next. Why don't you help me take this discussion forward? And already Ambalika and Aditya have touched upon some of the shortcomings that are starting to emerge. And perhaps there's a distinction now in terms of the risk perception, execution risk with greenfield projects versus operating assets. So if you could, based on your perspective and your experience in the Indian markets, could you prioritize some of the major risks that you see from your perspective? And then we can try and deliberate upon them to figure out what are the ways to solve for them to accelerate India's pursuit of its 500 gigawatt target. So Deepak, over to you.
Thanks, Arjun, and thank you for inviting me to this panel discussion. It's great to hear all of my co-panelists and also experts before us. I mean, I would put it this way that one could argue whether these are risks or these are operational challenges, which one should be ready for as soon as you enter India market. Actually, I would rather want to put it that way, because each country has its own different way of working. And it's not that there are a lot of risks which are specific to RE sector. Actually, those are ecosystem level risk that any Indian business has been sort of dealing with. As we see more and more inflow of foreign capital, more and more sort of foreign funders and foreign developers interested in the sector, we clearly see sometimes they get sort of a little bit more bogged down than others, some of like us who are sort of India based and India focused. But yes, there are few challenges, particularly in the short to medium term. The commodity price and the resultant price, which also I think IEA team also very clearly put forth that solar module prices and wind prices have increased manifold, is a short-term phenomena. Maybe it will keep on for some time, and therefore delivery of some of the projects which are otherwise yet to happen is becoming a little bit difficult. But at the same time, I don't see that impacting our overall 500 gigawatt target or our overall trajectory for achieving 500 gigawatt targets. In fact, I wanted to start with this, but then you wanted me to answer the question first, that actually India taking up a position to really be in that driver's seat, and Prime Minister Modi actually saying we want to achieve 500 gigawatts is something that itself has given a lot of boost to all the investment community and the development community, that India is at least thinking at that level. Otherwise, there were sort of from some sections questions already coming that, okay, by the way, we wanted to achieve 175, we have achieved 100, including hydro, we have achieved 150. What next? So I think from a signaling perspective, that's a great signal. Some of these issues, one of which I already said is the short-term price rise in commodities and resultant price rise in electronics and resultant price rise. That's one thing which as an industry, we have to work together. And maybe we are all learning as we are growing size and scale. There could be policy level interventions also in terms of whether there is a possibility to intertwine for future such shocks, such commodity shocks, whether it is possible to have a tariff linked to commodity prices, for example, which will give little more comfort to investors and developers, at least for future projects, and if possible, even for past projects or the recent projects that have happened. Another thing which we are really looking forward to as existing investors and developers, having something close to 7,000 megawatts of existing operational capacity on the ground, and having another sort of pipeline of close to 4.5 gigawatts. What we are really looking at is government providing even more stronger signals to all the investors that the vintage investments are going to remain safe. Government has been actually talking about it a lot, central government in particular. States have started to understand, but at the same time, there's a bit of a engagement going on between states and developers, which is all of it is not so positive. But at the same time, the kind of comfort that central government is giving on that front makes us feel very, very optimistic about it. Fact is, we have to reach certain level of solution soon to give a very clear signal to investors worldwide that, guys, we are with you, whatever may come in future, and you need not worry about when you put your investments in either utility-led or utility procured renewable energy, or maybe our interventions towards green hydrogen, or our interventions towards high capacity of storage assets that we want to achieve in the country. Then the third, and at least in the initial phase, the last bit is related to this sort of vintage or the broader distribution sector challenges that a lot of it has evolved, a lot of it has been resolved. But still, some last bits of it, particularly again, central government has been very, very keen on enacting amendments to the Electricity Act and revising and reviewing the national electricity and tariff policies. And in the last, if you look at last 1 year, the number of and the quality of rules, new rules promulgated by the central government towards achieving some of the progress on distribution side reforms, transmission side reforms, and even generation side reforms is actually much more than at least qualitatively what I've seen happening in 5 years prior to this last 1 year. So actually government has been really taking very, very proactive steps. Government has announced rules on general network access on the transmission side. Government has announced rules on payment sort of security and payment certainty for renewable as well as thermal projects under state PPAs. Government has pronounced rules to ensure ease of change in law mechanism. So all these things actually have happened in last 1 year while COVID was still on in rest of the parts of the country. This sector has actually seen progressive outlook coming from ministries and departments, and implementation of many of those things is happening as we talk. So I'm saying all these signals together are large sizable market, a clear at least focus on resolving or at least giving good enough comfort on vintage issues, and then promulgated rules, regulations, and policies, which again give a very clear direction that yes, you guys might have immediate sort of issues or challenges which are bogging down the operational aspects of the projects on the ground. But from whatever support can be given from the broader legislative and regulatory framework, that makes me feel very, very still bullish about these targets and bullish about that we should not have much worry in terms of achieving these targets. Thank you.
Lovely. Thank you so much, Deepak. You have actually really fleshed out a number of these challenges, and that's very useful because it will help us drive this discussion forward. Surbhi, let me bring you in here, and we'll take off from one of the points that Deepak just made. So he talked about the vintage issues and the fact that, I mean, there is some movement at the state level for, let's say, the retrospective renegotiation of contracts. That is for contracts directly made with states. At the same time, the panelists have also indicated that while, of course, the PPAs with the central government off-takers were usually, quite safe, we've seen instances where states have been kind of reluctant to sign PSAs for a very long time. So this is adding execution risk to even the central government off-take projects. And Deepak sort of hinted at a regulatory solution in terms of the regulation, the Electricity Act, and other respective regulation. From your perspective, what can be done to reduce the source of uncertainty for developers and to sort of prevent this from ballooning any further? Surbhi, your views on this. Over to you.
Sure. Thank you. Thank you so much, Arjun. I think the discussions have been very interesting and I have been reflecting upon them. I think all the points on what is impacting and what is conducive for the renewable energy uptake has been discussed. Now, in terms of the solutions that we foresee, there are multiple things that we are looking at and trying to work along with government to come to certain, I would say closure or to advancement in terms of plugging the gaps that we are seeing. So for instance, take the one very important point which has been discussed is about the off-taker risk or the creditworthiness of the distribution companies. In fact, one of the questions on the chat is also talking about those kind of aspects. Now, see, there has been issues definitely, and as I keep repeating myself across various discussions, that India is like a so to say multiple countries clubbed together. So every state has its own direction, their own regulatory mechanisms, though being governed at the central level. Now, having said so, there have been setbacks in certain states where the renegotiation of the PPAs were talked about, and some of the projects where the bank was also supporting, and one of those the presentations talked about, the most innovative one, solar, wind, hybrid, battery storage, saw a major setback, and we are still trying to come up with a solution to it. But the thing is that, the government has taken cognizance of it. And as we see that the thrust is more and more on renewable energy, we are seeing that the states are turning around. And I'm not talking about the states which are only renewable energy rich, but also the states which are not. For instance, if you look at the Eastern Belt, these states have so far not been able to catch up with their Western and Southern counterparts. So these states are now much more forthcoming and much more conducive to adopt renewable energy because they know that going forward, they have to adapt. So better to do it now rather than later. So we see that, the states like Chhattisgarh and all have come forward and they would like to really look at the peaking demands in their own states met using the renewable energy rather than, going to the markets or to have expensive PPAs serving the needs only for those duration. So these kind of thought processes are changing. They are definitely paving the way. When we look in terms of the, the forward-looking approaches, one thing which I think is very important is the credit enhancement instruments, which the financial intermediaries, NBFCs have to come and to, build together. As a seed money, MNRE had provided it with SECI and they were signing PPAs and PSs, but now their PPAs and PSs are far more as compared to what the seed money was provided. So how commercially we can bring together those mechanisms inbuilt so that the investments are more robust and the tariffs hence are more conducive for the adoption by the distribution companies. I think it's very important. The other opportunity that I see which is linked to this is the credit worthiness. When we speak about it, there is one segment that is distribution companies, which are generally obligated by RPOs and all, but there is another segment, a whole new segment about the bulk consumers, which are now looking for greening their own, industries or manufacturing or production units. For instance, you talk about Indian Railways, they have their own goals to go green 100% by 2030. There are, other major players who are sitting by the fence, who have their internal targets, the data guzzlers like cloud servers and other, software kind of facilities. These all bulk consumers are looking for tying up of the power to be produced, even at a premium. So the firmer power is going to be the need of the hour to serve the requirements of these consumers. So the top up, I think, is okay at the moment. And as other panelists spoke about the scale, it will automatically come in, right? Because India, the per capita consumption of energies is still very low. And we see that as we look forward, the energy demand is expected to go double in next couple of decades. So there are a lot of, I would say, drivers, and there are a lot of solutions, but how to plug that all in is, I think, very important. Back to you, Arjun.
All right,
Arjun,
if
I can just
please,
offer a
please.
little nuanced view on this whole biggest elephant in the room, which is creditworthiness of the discoms. I mean, that is something as a movie we've been seeing for last 20 years, right? It's not something that has just erupted, last month or in case of renewables alone. I personally, I am a firm believer of, law of land prevailing ultimately. So, sanctity of contract is not something that disturbs me that much. But the issue around dispute resolution processes being never ending is where the problem is. Because there are enough and more kind of, successful examples. Now you take Maharashtra or Gujarat or Rajasthan, whatever have you over the last 4 or 5 years, wherever people try to kind of play truant, ultimately they did have to kind of, pay. So I would imagine something like that would also kind of come through in states who are trying to, do something which is not as per the dotted line. But the problem is if it takes 3, 4, 5 years, then there are issues around working capital. Then there are issues around, incremental flows getting compromised because people want to first see the resolution of these things before they put, or commit more capital into the country. So I think we would probably need to have some mechanism where whether it's, the regulatory bodies or the high courts, but within 6 months, 12 months, a decision is taken and then, life goes on. But if it drags on for 3, 4 years and then an outcome comes, which is even positive, it kind of, has its own implications in that interim period. I just wanted to share that perspective as well.
Right. Fair enough. And like you pointed out, that is the biggest elephant in the room. Ambalika, do you have any views on how that elephant can be tamed?
So yeah, sure. Thanks for that. We actually, took the lead in a green, what we called a Green Frontier Initiative, and we had some, financing institutions like banks, DFIs, both domestic and international banks. We had RBI in the room with us. And some of the suggestions that came through for the same thing was, you need to have deepen the bond market, have long-term interest rate, some certainty on interest rates, so longer tenor facilities available. They also came with, a lot of regulatory suggestions, which was really how do you encourage domestic banks to fund these projects? Then the likes of IFC actually again talked of facilities like what they call the risk sharing facilities or partial credit guarantees, and we definitely need these. And what has happened as a result of that initiative, which we've just come out with that report, is we had both IFC and RBI on the panel with us, and a dialogue has started, and I really hope that that is one of the things that leads to something, because it is definitely needed in this sector. And so you have to have a bunch of perhaps regulatory and policy level changes in the financing space, which could be around PSL, around capital adequacy, etc., that kind of thing. Then you have, something, I agree with Aditya that yes, the court processes, the processes of settling a legal dispute we are experiencing one firsthand takes forever. And this is something that has to be, the pace has to quicken, and this applies across all sectors in India. But I also feel that DISCOMs per se are not, I mean, we all know that they're not necessarily credit-worthy and not in the same boat, all of them. So we have to, come up with mechanisms which help that. And we've seen something in the smart metering space. What government has done over there is they've actually come up with some kind of VGF, which is given to the DISCOM and so that encourages them to install smart meters, put out tenders for installing smart meters. At the same time, they've come with a standard bid document. Thirdly, that's also making it more cost effective. Fourthly, they've also in the standard bid document talked of a security mechanism, which gives us some comfort that the money that comes in is going to, where do we stand in the waterfall of payments that a DISCOM makes? And I know personally that, we've engaged with World Bank, we've engaged with DFIs like AIB, who have said they're very interested in providing some kind of, tripartite arrangement, which could really backstop this. But they're also looking for some support from the government at the back of that. So there are, DFIs and multilats are definitely not looking at taking straight risk. But again, there's MEGA also from the World Bank. So clearly, we have to address this on various fronts.
Right, and perhaps the hardest problem to solve. But I want to change gears slightly, and I want to pick up from, let's say, a point that you made, and I want to come back to Aditya on this, and before I get to Deepak and Surbhi. So Aditya, Ambalika mentioned the bond market, perhaps in a different context, but also from the perspective of the financing of India's 500 gigawatts, we need considerable, recycling of primary debt that is extended by banks and NBFCs. And we've seen so far that, Indian developers have been quite successful in tapping the international bond markets. So for example, a CEEW Center for Energy Finance study indicated that in the first 6 months of 2021, Indian developers raised more capital in 6 months than in any other single calendar year previously. However, we've not seen the same kind of success in the domestic bond markets. And why I wanted to come to you is, of course, that because earlier this year, Vector Green, which is of course the GIP-backed platform, was successful in raising 1,200 crores Indian rupees, which is around 160 million US dollars from the domestic bond market. And this was a quite a rare kind of occurrence. So could you talk a bit about this bond issuance and also in the wider context of challenges in raising capital from India's bond market?
Yeah, no, this is very interesting. And just to set context, GIP as a fund manager, we raised 80 billion US dollar in just last 12 months across different platforms. So it is not that offshore markets are alien to us, but especially in the Indian context, there were a couple of compelling reasons as to why we did what we did. Namely, one is, the currency risk. As compared to a lot of other geographies, we all know the Indian PPAs are rupee denominated. So you have, rupee denominated cash flows for next, 15, 20, 25 years. So, going back to Finance 101, it just kind of makes sense to have your liabilities denominated in the same currency as well. So that was, the first thing that we were thinking of, that we wanted to predominantly have our liability side of the balance sheet denominated in rupees and not a foreign currency. Secondly, purely from a commercial standpoint, the kind of pricing we got from the domestic market, of course, we did a lot of things that I'll touch upon, but pricing that we got from domestic bond market was so compelling as compared to what I would have got from, dollar market. The dollar market, I would have got 4.5%, like most of my peers did. I did rupee bond at 6.5%. Now, there is no hedge you can get for that differential 2%. So it would make sense if you just want to keep it open, then a 4.5% dollar bond makes more sense from that standpoint. But if you overlay a 6% hedge, on top of 4% borrowing, you're talking about landed cost of 9-10% from the dollar market. So I just didn't understand as to why I would need to do that. Of course, there are other compelling reasons that my peers would be more equipped to talk about. One, of course, is the scale or the depth in the Indian market, which is missing. So in our context, as you said, all we had to raise was, $170, $180 million, as against $1 billion or $2 billion that, people typically would want to raise sequentially over a period of time. So that is something which the Indian markets do not provide in terms of depth. A second thing which also kind of, made it compelling for us was the ease of issuance. So, from start to end, we were able to tap into the domestic market in a matter of 2.5 months. Whereas I'm given to understand an offshore bond issuance, unless it's for repeat issuers, it does take, anywhere from 6 to 7 months. And then, of course, there are issues like ticket size and transaction costs and all that, which is much more compelling in the Indian context. So those were the reasons as to why we were driven towards the local market. And in terms of constraints, I did mention there is a lack of depth. Tenors are not as favorable as you would get in offshore markets. You would still be hamstrung, dealing with 3 to 5 year tenors as against 7 to 10 years offshore. So those are the things you are forced to deal with, and there is no liquidity. So there are no market makers. So those are the things that one would need to continue working on. But we did want to have an opening so that at least the mutual funds, the provident funds do understand what GIP is. They have some face familiarity with Vector Green, so that next time we want to do a bigger issuance or a larger portfolio, then at least there is that comfort and familiarity built over the years. So that was the overall kind of thinking behind what we did.
All right. Thanks for that, Aditya. At this stage, I want to take a couple of questions from the audience, the Q&A. So Deepak and Surbhi, I want to bring the both of you in, because we have questions on, land and transmission infrastructure and the challenges associated with that. And, Deepak, let me start with you first, because of course, Renew recently won a capacity under the RTC2 tender, where, you're blending renewables and thermal. I mean, part of the reason is to solve for the intermittency challenge with renewable energy. But more broadly, like Pablo talked about in his presentation, hybrid tenders are geared towards facilitating integration and also more efficient use of land and transmission infrastructure. So how do you see, view these projects? Is the execution risk lower as compared to, plain vanilla projects? Are the DISCOMs, for example, what I mean specifically is, are the DISCOMs more welcoming of these kinds of contracts as compared to plain vanilla solar or wind? So how do you see the hybrid, tender kind of progressing in the future?
No, sure, Arjun. I'm glad you asked that question, because actually, now there has been sufficient number of transactions that have happened, PPAs and PSAs that have happened on plain solar, plain wind. Initial reaction, and again, all of us sort of pushbacks change. So initial reactions from DISCOMs, I would say, was not very positive when hybrids had just started, or RTC or peak power or any of those things. It took SECI, the intermediary agency, and also even the winners, a lot of effort to bring DISCOMs to that point where they started to understand as to what is the difference between a plain wind or a plain solar and some of these hybrid concepts. But what I have realized over a period of time, as DISCOMs have started to understand these constructs, they are more and more keen to actually buy such hybrids for multiple reasons. And one of the key reasons, as you rightly pointed out, is that it is relatively not just technically easier, but also economically more viable to integrate with their existing infrastructure, existing grid. So there have been certain assessments by the Central Electricity Authority, and the cost of integrating a plain solar or a plain wind project into the grid has been estimated anywhere between 40 paisa to 1 rupee 50 paisa per unit. I am not getting into whether those are right numbers or wrong numbers. Those are CEA estimates. And in comparison to that, when DISCOMs see that they can get a flatter profile, or they can get a more predictable profile, or they can get a product which is close to 70-80% utilization, CUF product, then they see by default that, okay, by the way, I can integrate it much better in my existing grid rather than relying a lot on my existing thermal assets or having a lot more flexibility into the system. So the offtake or the interest of distribution companies in some of these, I would call it value-added products, is increasing. They are starting to get the value. They also have started to understand that some of these products are going to be slightly costlier compared to plain solar, plain wind. But there is much more value that they provide to the distribution company at the system level. But then sort of capturing the part B or element B of it, in fact, government is also realizing that if they continue to do or push for plain solar, plain vanilla, actually the day is not far away when they are going to see a lot of problem with even managing the interstate grid, the central transmission utility. So in fact, rightly so, they are now also moving towards, okay, what role can storage play? And again, some of the recent assessments suggest that between now and 2020, let's say 26, 27, we will still need 40 to 50 gigawatt hours of storage. So between now to 2027, if we need 40 to 50 gigawatt hours of storage at the least, so that means we'll have to really bid for somewhere between 5 to 6 gigawatt hours per annum. Not a very high scale, but at the same time, scale good enough to start with. And again, in that direction, there is a lot of industry support as well. Government has made up its mind through, again, central intermediaries to do some of the plain storage bids, vanilla storage bids, but also generation plus storage bids, targeting somewhere close to 2 hours of storage to begin with. And that, I believe, is the right approach rather than going for 4 hours or 6 hours of storage. Because say distribution companies with their current financial position, with their current set of consumers, they do care about cost. The more storage you want to add, the more costly product becomes with not equivalent value at this point in time. Maybe we need a lot more storage beyond 26, 27, but then the storage tariffs are also, storage capex is also coming down significantly. So just like we started our solar revolution in 2010, 11, 12, 13, 14, and then scaled up significantly when the numbers started to come down from 18, 19 rupees per unit to 5, 6 rupees per unit, and now to 2, 3 rupees per unit. We did not say on day one that let's do 20 gigawatt of solar on day one. Similarly, storage has to really emulate solar story. And then last bit on that, now with this other interventions coming, which includes EV, which includes green hydrogen, which includes sort of other byproducts of hydrogen, they are also going to add actually certain level of flexibility into the grid on the consumption end. We cannot only look at the generation flexibility, but there is going to be a lot more added flexibility at the consumption end by all these interventions. And we should really therefore design our system in an integrated manner as to how can we tweak consumption patterns for existing consumers and upcoming consumers, in addition to looking at how the generation side of it is evolving. And I again don't see any major concern in terms of achieving these targets. Transmission line additions have been slow, relatively slow in last 4 or 5 years. Last 2 years obviously impacted by COVID. But again, glad to share with the group, but also actually audience, that recently the Government of India has actually approved a large number of schemes under a very different framework, and they're not going to wait for those projects to start happening for bids to happen, because this is a major challenge that industry brought to the government's notice. Project deployment getting stalled or delayed because of lack of transmission infra being available. And government has taken a very, very positive note of that rather than sort of giving it back to the industry. They have decided to go ahead with certain transmission projects, and that is going to again help us scale renewable energy much faster.
Thank you, Deepak. I'm also glad you talked about hydrogen, because we have quite a few questions on hydrogen in the chat itself. But now we are sort of coming towards the end of our panel discussion. So let me actually, Surbhi, I'm going to have to unfortunately put you on the spot. Right, we've discussed multiple challenges and multiple solutions. Could you, and I can give you time to think if you want time to think, but could you, for example, give me your top 3 interventions that you think are essential for India to elevate its level of investments in pursuit of 500 gigawatt by 2030?
Sure, Arjun. I'm happy to be on the spot. Not a problem at all. So for me, couple of things that one need to do, and maybe I may overshoot 3, so please pardon me for that. So I think land transmission challenges are very important. So important thing to consider is that how to optimally utilize the available resources, which are very scarce in nature. So for instance, round the clock firmer power, I think it's very important so that we can generate more number of units at the same available area. So round the clock and firmer power supply is very, very important. It will also take away the question mark around renewable energy, which is intermittency. So that is first and foremost thing. And encompassing that is, of course, the virtual power plants that one must also look at, that how we can use the existing and the proposed assets to function together and optimally produce the generation profiles to meet the consumer requirements. The second, I think, is equally important is to look at the recycling of the funds which are already available, which the panel already discussed about, be it alternate investment funds or through InvITs. That is most important because the funding requirement that we are looking into the future from today till say a decade also, as per our internal estimates, it might require up to $500 billion of investment as well, which is huge, and everybody has a pie to share. So everybody is required to look at the options which are available to them, be it in terms of newer investments to be raised domestically, internationally, bring the creditworthiness more into the center stage so that the investments can come in, and to look at the available funding to have more leverage or more recycling of the funds. The third point, which I think is important and which everybody has raised, is about the green hydrogen. So what we should look at is not within the power sector, but beyond it, because decarbonization of the sectors beyond power is going to be extremely important, and it will automatically feed into a 500 gigawatts of coals. Now, that itself is quite a huge landscape and a canvas to paint, because a lot of policy, regulatory, technical challenges are there at the moment staring at us. But I keep saying again that what solar was a decade ago, green hydrogen is today, and it is going to change the world much faster. I think IPCC's red code is very important to consider, and that should be our driving factor. So maybe I'll stop here. Arjun, over to you.
Lovely. Surbhi, you're right. It is a code red for humanity, and it is high time that we act. And we got a lot of very interesting, wide-ranging, diverse, and thought-provoking comments from this very excellent panel today. Unfortunately, we are nearly out of time, so all good things come to an end. Now I will hand over proceedings to Paulo Frankel, who is, of course, the head of Renewable Energy Division at the IEA, to reflect on today's proceedings and offer some closing remarks to close out the session. So, Paulo, over to you.
Thank you, Arjun, and thanks to all the speakers and the distinguished panelists for a phenomenal discussion. I think it was great information, and I will absolutely not dare to summarize it all. So apologies in advance if I miss something, but I would like to highlight 5 points from my view. First, we are not speaking about a small change. As Arunabha said in the beginning, we are speaking about a whole economy transformation of India in the context of something that was not there just a few years ago, which is net zero as a predominant narrative in the world after COP26. This is a huge turning point. It's not a minor change and the consequential marginal improvements over the year. Second, because of that, the involvement of the private sector and having affordable financing is absolutely crucial, because this is what is needed to get things done. And this is why we really praise the collaboration with CEEW, why we think such a workshop like today in this discussion is so timely as important. And I would like to just to pick one slide of my colleague of Pablo that showed the spread comparison between India with China and the US as a critical point of the analysis, and to where to start to find what is needed, which is the right balance to give a sustainable returns to the industry, while at the same time give affordable costs for Indian consumers and the economy. Now, you listed a lot of challenges. I would say the following: we should not be distracted by the very important short-term challenges that we have today, the high commodity prices. We should, of course, work together to solve them, but not be distracted by those and concentrate more with the systemic issues that we have in India. And I would mention three. Someone called the financial creditworthiness of Discoms a 20 years old movie. I agree. And India is not alone, to be honest, in this context, but this is really one crucial point. The second issue is around land acquisitions and the optimal use of resources. Someone else used this wording. And one third point, which is also very important, the consistency of the policies of the different states. Well, to me, if I have to select those systemic issues that are the real bottlenecks, these are the three top ones. Now, fourth point, then the question: can India do it? Can India address and match the ambitious 500 gigawatt? And someone said, being in the driving seat. I believe yes, for three main reasons that I heard. One, the recognition that this is an irreversible trend for the country, with a very strong political indications from the very top, which is influencing all the rest, including now states policy. Someone mentioned the states in your Eastern Belt. We have very similar things in Europe. Don't think that India is alone in this. We have some European countries that are much slower than others to act. Second, the scale of this market is huge and has the impact, the capability to attract also financial investors from outside. And third, I would like to mention innovation. And innovation in three aspects that I heard. One is obviously hybrid plants, but someone also mentioned bulk consumers. I very much agree with that. To me, this is a game changer, not just in India, but everywhere in the world. And third, green hydrogen. This would need another workshop, but I can only confirm that from our point of view, India has a special place in the world for a hydrogen economy as a crucial for the perspectives of both production and domestic consumption that other countries do not have in the world. So my fifth and last point, and then I promise I will shut up. This is why overall, while I think we are facing phenomenal challenges, I remain positive. Someone said bullish in the coming years, because I think there is an unprecedented momentum in the country and also elsewhere in the world that India can actually, with a good, consistent policy approach, match these challenges and get to the 500 gigawatt renewables targets, and maybe even further than that. The IEA stands ready to continue to collaborate with the ministries, with you, CEWs, with other stakeholders in India to support the country in this road. And I really, with that, I stop. And I thank you again very much for an excellent discussion and an excellent input. And of course, our CEW colleagues for a phenomenal collaboration and organization of the workshop. Thank you very much. Arjun, it goes back to you.
Nope, I think I'll let you have the last word, Paolo. That was
okay.
I just like
then that was the last word. It's a thank you.
Absolutely.
A big thanks to all you.
Thanks to all the panelists. Thanks to the audience for tuning in. All right. Have a good day.
Thank you very much.
Good evening. Good afternoon. Bye-bye.